Professor David Karn here, lecturer of Bolt School of Business at Mount St. Mary's University, and we're going to discuss current liabilities in payroll. We're going to start off with payroll here. And remember, a payroll function for a business can be very, very essential as far as obviously you want to make sure that you are paying your employees the correct amount and also on time, as well as collecting all of the appropriate taxes and other deductions that might be or need to be made from their particular paycheck. So let's talk specifically about employee compensation and payroll. Obviously, there are going to be many liabilities that are created as a result of this. And typically, if you're dealing with a service-based business, payroll would be the major expense. And really, when we think about the different types of pay that employees can receive, you can really look at multiple ways that someone can receive compensation, specifically salary, compensation, commission, bonuses, benefits. All these things are going to play a role in the payroll process. So we look at two main amounts. The first amount is the gross pay amount, and obviously that's the total amount of salaries, wages, commissions, bonuses, etc. that are earned by the employee during the pay period. And then all of the deductions that are going to reduce that gross pay amount into the net pay amount include many things, and we'll talk specifically about those many things here shortly. But remember, net pay can also be referred to as take-home pay, and that's what, in most cases, you either get in direct deposit in your bank account, should you have that, or the actual paycheck that you would receive from your business. So what are the things that are deducted or withheld from employees? There obviously are certain required deductions and then also optional deductions that an employee can take advantage of if they so choose. Obviously, under the required deductions, one of the most important things are the federal and state income tax. And then we have our Social Security. And then obviously there might be, you might have your local income tax and some other different things specifically applied to where you live. Optional deductions, think of things like your insurance premiums if you want to make a contribution to your 401k or retirement plan. As an example, you might want to make a charitable contribution. You might want to have your car payment taken out. You could have your tuition if you're paying for someone to go to a private school, that you could have that come out of your paycheck and go there. Really anything that you want from an optional perspective can be deducted from your paycheck as long as your employer is willing to help you out there. All right, so let's see what goes into this. When we think about employee income tax, we really are kind of, as a business, aligned with following the guidelines that are set forth by the tax documents that an employee completes. So obviously the amount withheld will depend on the employee's gross pay, the number of withholding allowances claimed, and typically it says unmarried taxpayers claim one allowance, and if a childless a married couple will usually claim two allowances. Really, it's one allowance per person. So here's a tax document, your W-4, your employee's withholding allowance certificate. And this is just a very simple document where you fill out your name, address, social security number, and then you claim the number of, you say how many allowances you're going to claim. In this case, looks like Ryan Park decided to claim 3 allowances, and then you sign it and you date it. And then underneath here, the employer completes this particular information there. When we think of our Social Security, we think of that, and that can be referred to as FICA. And basically, FICA really consists of 2 items that are withheld from a employee's paycheck, and that is really Social Security tax, or referred to as OA SDI, standing for Old Age Survivors and Disability Insurance, and then also Medicare. So there are two things there that must be withheld. Many companies use a payroll register to be able to help us track this. And you can see here in the first column we have our employee name. So we have that here. And then notice that it's important to know how much they had in earnings before this pay period. So for example, James Colin had already been paid $112,700. He's going to receive $10,000 of earnings for this period, bringing his cumulative earnings to $122,700. Now, notice that we have specific things that are going to be withheld. And if you look at it this way, you can see that we have Social Security, we have Medicare, we have income tax, we have health insurance premiums, any other deductions. And so if we add all of these things up right here, that equals the total withholdings. So once we take the withholdings, this 2612 number, away from the $10,000 that they are making currently, so we subtract that to get the total net pay, which would be $7,388. Now notice they also have what check is specified there, as well as what account they're going to debit. Here's what we're going to debit. Salaries and wages will always be debited for the gross amount, the gross pay for each employee, and then obviously all the deductions will become liabilities, and then we will pay them to the appropriate individuals when we cut their check. All right, so we would do this as a benefit to help us prepare the journal entries specifically for the payroll. Now, let me pause here a second. Specifically, a lot of times companies may decide to outsource payroll. The reason that they would do that is they want to make sure that the payroll is done properly, and that if there's a mistake, then people can go back and they can check it and they can really make sure that the error is fixed properly and in a timely fashion. Now, one thing that we need to address here is what are the percentages of the Social Security that are withheld from each of our paychecks for both Social Security and Medicare. Now, what you want to remember is that in this current setting, what you want to use is there's a threshold of $117,000 for Social Security. Now, once an employee has earned $117,000, they are no longer responsible for paying any more Social Security for the year. Now, the rate for that is 6.2%. So what you want to remember there is 6.2% for Social Security, and you pay that up until all the way you've reached $117,000. Now, Medicare is 1.45%, and there's no threshold or limit for Medicare. So as you can see, in some cases, if you look at this, actually even the first case, James Colin, after this particular paycheck, Mr. Colin will no longer be responsible for paying Social Security. In fact, you can see here that he only had to pay, it looks like, so we have $117,000 as the threshold, minus $112,700. That comes out to be $4,300 that is subject to OASDI, which would be times the 6.2%, and that's how they get $267. So basically, now after this paycheck, James Colin will no longer pay Social Security until this year is over. So keep that in mind. Make sure you realize that if the employee has met that threshold, they will stop paying Social Security. Now you can see where they did take the $10,000. We think of the, I'll just write this over here, $10,000 times the 1.45%. Obviously, that's $145 to Medicare. So you can see that that number there is the correct number, and the 267 matches that there. So notice that the no threshold applied. The Medicare was paid on the full $10,000. Okay, so you could go through and look at each of these examples, and you could see how the all the things were specified and calculated. Now, this would be this federal income tax would be according to a chart. They tell you how to calculate that. The health insurance premiums, that's voluntary, depending upon the employee if they have health insurance or not, and then usually the employee pays a portion and the employer also pays a portion, and then if there's any other deductions. So this number here, as we go over to the next slide, the $28,580 in the bottom right corner is important because we have, the next slide here, that number as our debit to our salaries and wages expense to record employee payroll. So we debit that, and notice that we credit each individual of the other columns here, the 1419, the 414, the 55716, the 645. So really down here is what we're looking at. And you can see that we credit each of those things. Notice that we have FICA for OSDI, Social Security. This is Social Security, just to kind of keep that in line there. Medicare, employee income taxes payable, employee health insurance payable. United Way, this was like a charitable contribution. And then finally, notice that the salaries and wages payable, the $20,326, is the total amount of net pay that we have here in the third column there near the end. Okay, so if you look at this here, what are all these? These are all current liabilities that must be paid. And that's how you would journalize employee payroll. Now, we're not quite done yet because employers must also pay payroll taxes, and if they have to pay any portion of benefits, they'd have to pay benefits expenses as well. So, the one other thing that we have to realize here too is that we as an employer have to match Social Security. So make sure that you realize that really this amount here, this employer FICA tax, is an additional match to what the employee paid. So we want to make sure that you realize you're going to have that the employer is going to send in double the amount for both Social Security and Medicare. They also have to pay state unemployment and federal unemployment taxes. Remember, in this particular case, that the state unemployment tax would be at 5.4%, and the federal unemployment tax would be at 0.6%. Now, what you want to remember here, and be very, very careful, the mistake is made oftentimes. Make sure you realize this is written as 0.006, because a lot of times students will take this and they will multiply it by 0.06, which is actually 6%, not 0.6%. So just keep that in mind. All right, so you can see here that we just did a calculation. Notice that we added up, we had to match Social Security and Medicare, so that's an additional amount, and then both federal unemployment taxes and state unemployment taxes. Now, the other thing that we need to mention here, and let me just go back to the slide here, is that basically, if you keep this in mind, you must only limit the federal and state unemployment tax to the first $7,000 of earnings. So both of these things here, the federal and state unemployment, so FUTA and SUTA, on the first $7,000 earned by each employee. So that's the key term there, the key threshold. Make sure you remember that once an employee has gotten over $7,000, the employer no longer pays any more state or federal unemployment tax. So again, all these here are current liabilities, and those are things that we must pay. Now notice here that we as an employer had an additional $2,073 of payroll tax expense in addition to what we had as salaries and wages expense. So it does cost more money than we think. Remember, and this is not very uncommon. I mean, it's so easy to think, I'm going to hire someone for $50,000 salary. Well, certainly you're going to have a $50,000 expense there, but it's not atypical that you'd have an additional $5,000 to $7,000 a year for other payroll taxes and benefits expense that you might incur. So it may not cost $50,000 to employ someone. It's probably going to cost you $57,500 to $62,500 to employ that person, if not even more than that, depending upon what their benefit level is. Okay, so there's a couple things they point out as far as controls, very basic things. Basically, should be automated, then prepared by hand. Again, it's very commonly outsourced. And then obviously, once we disperse payroll, if someone is getting a paper check, obviously they have to present their ID and sign for it. And then to kind of make sure that people are still getting paid appropriately, obviously the HR function of hiring and firing employees should be separated from the payroll preparation. And then very commonly, if you're hourly, a time clock on either some type of login computer or direct deposit into a bank account would be used. The time clock would track hours appropriately, and the direct deposit for most people is required in many businesses, so that they don't have to worry too much about getting a paper check to their employees, and their payroll, their net pay is delivered on time when it should be there in their account. Just because you have direct deposit, though, doesn't mean it's going to be there when it's supposed to be, because it can be delayed for certain circumstances. So you need to be aware of that possible scenario. Okay, let's look at a problem here, and what I'm going to do is I'm going to build this up for us. Basically, there are three parts of this problem, and I'll just go through it each slide by slide, taking a requirement. But let's read it first. Jenna Lindsay works at College of Boston and is paid $40 an hour for a 40-hour work week and time and a half for 4 hours above 40. Just remember that it is required that you get time and a half if you're an hourly employee for any hours that you work above 40. Now remember, if you're a salaried employee, it doesn't matter if you work 40, 50, 60, 80 hours a week, you're going to get your flat salary and you're not eligible for overtime. Okay, so the first requirement is to compute Lindsay's gross pay for working 54 hours during the first week of February. So let's do that. So we know that the regular earnings are going to be $40 hours times $40 per hour and that comes out to be a total of $1,600. Now let me change colors here, and we'll go to overtime at earnings. So we had 54 hours, and we've already accounted for 40, so 54 hours minus 40 hours that we've already of regular time. So we know that we have 14 hours of overtime that we have to account for, so 14 hours. So we know that that total will be 54 times. Now, remember, we have to get time and a half, so we're going to take $40 per hour times 1.5 time and a half. And once we do that, we see that basically it comes out to be 14 hours times $60 per hour. And that comes out to be $840. So now we can add up the $1,600 plus the $840, and we see that the total gross pay amount will be $2,440 for Lindsay. Okay, so that's valuable information, and we've got their first requirement knocked out. The next thing we need to do then is we have to look at the fact that Lindsay's single and her income tax withholding is 10% of total pay. Lindsay's only payroll deductions are payroll taxes. Compute Lindsay's net or take-home pay for the week. Assume Lindsay's earnings to date are less than the OASDI limit. So that means that not to 117,000 of earnings. So we're good there. We have to take all of the full gross pay is subject to that. All right, so let's do this. Let's take the gross pay to start off. We know our gross pay from the previous slide was $2,440. And let's use dollars and cents here because it'll probably come to the fact that we have to do that. Let's take out all of our withholding deductions. We know our income tax withholding is 10% of the full amount, so that's $2,440. And we take 10% times that. Notice that we're going to get $244. All right, then we know we have our FICA, our Social Security, and we know it's 6.2%, not to the threshold, so all $2,440 will be taxed, and that's $151.28. And finally, we have FICA Medicare, and that's the 1.45% times the full amount, never subject to a threshold. And that comes out to be $35.38. All right, if we add all these things up here, total deductions are $430.66. And we would subtract all those out, and our net take-home pay comes out to be $2,009.34. So on gross pay of $2,440, Lindsay's going to get either a check or direct deposit of $2,009.34. All right, then we go to the next slide here, and we have to journalize this particular situation. Journalize the accrual of salaries and wages expense and the payments related to the employment of Jenna Lindsay. All right, so let's see what we got here. It says they didn't give us a date, so we know our gross pay is always our debit to wages expense. And that was the $2,440. And then we just have our three liabilities. We know we have our employee income taxes payable, and that was the $244. The liability now, it's a current one. We know we have our FICA Social Security taxes payable for $151.28. We know that we have our FICA Medicare taxes payable for $35.38. Write that a little bit neater for us. Well, I tried. Okay. And then remember, we've not yet paid the payroll. We owe the payroll, so it becomes a liability. So we pay it with wages payable for the take-home or net pay of $2,009.34. If we look at this here, you can see this number here, again, is our net pay. And this other number up top, this was our gross. Okay. Now, once we do this, we still have to actually pay the employee. So we do that by knowing that this here is a liability. It says here we must pay this. So let's just do this since we ran out of space. I would simply just have to debit, let's do it on this here, wages payable and cash for the, just debit that for the $2,009.34 and credit it for that amount. Sorry, I had to sneak that in there. I just ran out of space there. All right. Now, the other last parts of this particular topic area, when you think of current liabilities and payroll, is we have some things that we might have to estimate from a liability perspective. In some cases, we may have a liability. We know it's there, we know it exists, but we can't figure out exactly how much what the amount is. As a result, we have to estimate that liability and report it on the balance sheet. We want to be conservative. It's really important accounting principle of conservatism. Make sure that you report what we need to report there. Always err on the side of caution. And then if you look at what they're talking about here, it's pretty common that these might be situations that we run into. We might have bonus plans, we have vacation pay, we have health and pension expense benefits, and potentially we could have warranties that we might have to fulfill if a company has a situation where they promise a repair of a defective product. Okay, so let's look at a couple of problems on each of these areas. Bonus plans, pretty straightforward. It says on December 31st, Peterson Company estimates that it will pay its employees a 3% bonus on $62,000 of net income. After deducting the bonus will be paid on January 15th of next year. Now, what you have to remember is that it's a 3% bonus of net income after deducting the bonus. So here's how we're going to attack this. The bonus calculation is really 3% times 62,000, but remember we have to do it after deducting the bonus, so we have to divide that by 1.03. So we get that comes out to be $1,805.83. Now, basically this 3%, you would change if you had a different percentage, you would make that, this would be whatever, this number here would change to whatever percentage, and then it would be down here 1 plus the really the percentage amount in this case, if it was, say, if it was 4%, it would be 1 plus 0.04, so that would be 1.04. So, and the top bar would be 4% times whatever the bonus was, and then divided by the 1.04. Just so if you had a different percentage, you know how to calculate that. That's a commonly mistaken calculation because of the way that they worded this. A lot of people just think it's the 3% times 62,000, and that's not correct. Okay, first thing we need to do is journalize the December 31st transaction for Peterson. Okay, so 12/31, what we're going to do here is we're going to debit our employee bonus expense, and that would be for the 1805.83, and we credit the employee bonus. What's wrong with my pen? Keeps going crazy on me here. I apologize. Bonus payable, and that's for the 1805.83. So that would be that one. Now notice that they're not going to pay the bonus until January 15th of the next year, and that's when we do requirement 2 right here. So we do it on 1/15, and simply we would just pay it. We would just debit the liability, the employee bonus payable, and that would be the 1805.83, and then we just credit cash because we're actually paying it out. So hopefully that's not too difficult. Again, this is probably the hardest part of the thing right here, when you have to figure out the bonus, make sure that you get that part correct. All right, then we look at really vacation, health, and pension plan benefits. Obviously, pensions are important to people. You want to make sure you supplement. Hopefully you can. If you end up, you currently have a job, or when you do get a job, you are or will try to max out your pension plan if it's offered to you. Roy Industries has 8 employees. Each employee earns 2 vacation days a month. Roy pays each employee a weekly salary of $1,000 for a 5-day work week. Okay, we need to determine the amount of vacation expense for 1 month, and then we need to journalize the entry to accrue the vacation expense for the month. Okay, so we know we have employees of 8, and we know that we have the vacation days per month. That would be 2. So we know that there are 16 really days a month that you have to deal with that. So now we have, how much do we have to pay them? So $1,000 a week divided by 5 days per week that you work, and obviously that comes out to be $200 per day. So we take $200 per day times the 8 days that we calculated, and we can, oops, not 8 days, but 16 days. This number here. And we see that the vacation benefits expense is going to be $3,200. So we've determined this amount. We've done that. That's the $3,200. Now we need to journalize it. They didn't give us a date, so we'll just put requirement number 2 in here to know what we're answering. We would debit an account called vacation benefits expense, and that would be for $3,200. And then we would credit vacation benefits payable $3,200. And then we would just make the necessary entries. If people took vacation, we would have to dip into that payable account. We pay it out, and then depending upon what the policies are, if you don't use it and you lose it, that could require us a change in a journal entry down the road, but we're not going to be concerned about that with this particular. Okay, then we get to warranties, and that is a pretty straightforward thing. A lot of companies guarantee their products against defects. Under warranties, you buy a product, you get a certain period of time where you're protected. If it would fail, you could take it back and get a new one. Obviously, the time period for a warranty is going to be very different by the different products and the companies that are offering them. Remember that, obviously, we're back to our matching principle again. You must match revenues and expenses in the period in which they occur. That principle requires businesses to record warranty expense in the same period that the company records the revenue related to the warranty. So whenever the actual sale of the product is made, the warranty expense must be recorded in that particular period. Hipster Corrector guarantees its snowmobiles for 3 years. Company experience indicates that warranty costs will be approximately 3% of sales. Assume that the hipster dealer in Colorado Springs made sales totaling $350,000 during 2016. The company received cash for 20% of the sales and notes receivable for the remainder. Warranty payments totaled $8,000 during 2016. Record the sales, warranty expense, and warranty payments for the company. Ignore cost of goods sold. Post to the estimated warranty payable T account. At the end of 2016, how much in estimated warranty payable does the company owe? Assume the estimated warranty payable is a 0 on January 1st of 16. Okay, so if we look at this here, we can see, let's do the T account over here. We can put estimated warranty payable. So we know it has a 0 balance. Let's put it, actually do our debits and credit properly doing here. So we know that the $0 of the beginning balance, we normally wouldn't put that, but just so we're just using this information that they told us about here. Okay, so let's do this here. We know in 2016, we know we're just going to put the year, we don't have specific dates. We know it told us in the problem on the previous slide that they made sales totaling $350,000 and they received 20% of the sales in cash and notes receivable for the remainder. So we know we're going to debit cash for 20% times $350,000. And we know that that is $70,000. We know that notes receivable will be for the remaining 80%. Oops. 80% times 350,000 comes out to be 280,000. And then we credit our sales revenue for the amount in full that we made. Okay, so that takes care of the first transaction. Now we need to estimate the warranty expense for the period. We know that that's 3% of sales, so we will debit warranty expense for 3%. And that comes out to be $10,500. Whoops, one too many zeros. There we go. And we would credit our liability, estimated warranty payable for $10,500. Now, it also tells us that warranty payments totaled $8,000 during 2016, so we have to show that we paid that amount. So we would debit estimated warranty payable for the $8,000, and we would credit the cash that we paid for $8,000. Now, it also wants us to report based upon our payment what we owe. Well, this shouldn't be too difficult. Let's go back to the previous slide. We started out with a beginning balance of 0, so we know we credited for $10,500 in the second journal entry that we did, and then we debited for $8,000. So in this case, at the end of this particular year, we have a $2,500 ending balance on that. And that concludes that particular portion of that warranties problem. All right, one more major section here, not too difficult. Basically, it talks about contingent liabilities, and really there's a format to go for throughout this, and we can see a chart here shortly. Make sure you know that a contingent liability is something that is potential, and really that it depends on a future event. So we don't know for sure if it's going to be a liability or not. So for a contingent liability to be paid, some event must happen in the future. And how we record this for business purposes is really based on the likelihood of events occurring in the future. And those three things are here. Is the chance remote? Is it reasonably possible or probable? So they put together this nice little chart for us. And we have really things here that the likelihood and how to report the contingency. So if it's remote, we do nothing. We do not disclose it. So nothing to worry about there if we deem it that it's a remote chance that it will occur. If the liability is reasonably possible, we will have to describe the situation in a note in the financial statements. We do the same thing. We describe the situation in notes or financial statements if the likelihood is probable and the amount of the expense cannot be estimated. Cannot be estimated. So that's the key there. Okay. Now, the final one, where it's probable and the amount of the expense can be estimated, you will have to record an expense and a liability based on the estimated amounts. You would actually do a journal entry to record this contingent liability. Okay. So the only one there that we have to worry about specifically as far as a transaction is concerned is the last one there. All right, so let's look at this last exercise here and see what we would do. Fernandez Motors, a motorcycle manufacturer, have the following contingencies. A, Fernandez estimates that it is reasonably possible. Oh, there's our key term, reasonably possible, but not likely that it will lose a current lawsuit. Fernandez attorneys estimate the potential loss will be $3,200,000. Okay, so here's what you'd have to realize here. If you know it's reasonably possible, what are we going to do? Notice right here, here's the key term, reasonably possible. We're going to describe in a note to the financial statement. Again, reasonably possible, very, very important terminology. Second one, Fernandez received notice that it was being sued. Fernandez considers this lawsuit to be frivolous. Oh, frivolous. So if it's frivolous, it's remote. So because it's remote, we know that we do not disclose. Do nothing. And again, we get that here from this right here, remote. Again, that was do not disclose. And finally, Fernandez is currently the defendant in a lawsuit. Fernandez believes it is likely that it will lose the lawsuit and estimates the damages to be paid will be $60,000. Likely that it will lose the lawsuit estimate. So guess what? Because it's likely, we need to record an expense and liability based on estimated amounts. So we need to do a journal entry. Okay, so that pretty much concludes this particular area here. Wish you good luck on the homework problems. If you have any questions, please let me know.